All right, so good evening, everyone. Earlier we looked at capital budgeting. Now we're on to cost of capital. And I shared some formulas in the chat earlier in the WhatsApp group. All right, well, let's look at this question. We're going to work through the concepts looking at the question. So Marriott Hotels wants to determine the minimum cost of capital for the cost of capital point for the firm. Assume it has the following financial plans. So we have plan A, debt 6%, 20% weight, preferred stock 10%, 10% weight, and common equity 70% weight. Now, the weights, of course, are just the proportions. I will know they must add up to. Yeah, something is wrong. Something would be missing if they're not adding up to 100%. So same here, plan B. Oh, I note here as well that it says after tax. So for debt, debt is the only one affected by a tax. And this is the after-tax cost of debt. All right, so 4 plans. And we have the cost of after-tax cost of debt, the cost of preferred stock, and the cost of common equity in each case. So the question says, which of the 4 plans above has the lowest weighted average cost of capital? Right, round to 2 places to the right, to the right of the decimal point. So that means for a rate, the percentage rate, we should have 2 decimals in that percentage rate. All right. Now, that means if we're working as decimals, we use four decimal places. So let's look at it. So the formula, since we're given the each one, in other words, this one is putting it on a platter. We're given the after-tax cost of debt, the cost of preferred stock, and the cost of common equity. So we're just putting everything together. So what we're saying here is, let me put it in words. For plan A, %20 of our financing is via debt, where the let's put the after-tax cost of debt is 6%. We also have another 10%. Right, where the cost of preferred stock is 10%. The rest of our financing, the other 70%, is via common equity, where the cost of common equity is 13%. Now, I said 20%, 10%, and 70% of the financing. But is everybody clear what we mean when we say the financing for the for whatever? Is everybody clear what we mean by the financing? All right. So
No, sir.
I was saying. So, for example, if somebody says, how are you financing your university education? You could probably say you're financing it from earnings, from salary. You could probably say, boy, you're financing it via student loan. Or you're financing it via gifts from family, parents paying the money for you, or your significant other, or so forth. But that's what we're saying, financing, that's where the money come from. Yeah, Tisan?
Yes, sir.
Yeah, man, I saw your mic. Oh, I thought I had a question.
Oh, no.
Yeah. But is that clear or don't though when we talk about the financing?
Yes, sir.
Yeah, man. That's where the money coming from. That's all I was saying. So we have 3 plans. They haven't stated how much money is being raised, but what they're saying, whatever the amount is, 20% of it is borrowed money, debt. Right? So 20% of the money is loans, 10% is preferred stock, and 70% is common stock. Right? So here we go now. So based on this, we have 6%, 10%, and 13%. The question being asked is, what is the average rate that the company is paying? So they're paying 6% on 20% of the money. They're paying 10% for 10% of the money. And for the other 70%, they're paying 13%. So we can see that the common equity carries the highest weight. So let's look at the formula. The formula says WACC, which is weighted average cost of capital, is equal to, all we're doing is multiply the weights by the rate. So WP means the weight or proportion of preferred stock. Well, let me start with debt. So WD is the weight of debt or the proportion of debt financing. So that would be the 20%. All right, multiplied by the, I will just put multiply, even though the formula normally just put, I will use capital letters for, I will do it. All right, so what that is saying is the weight of debt, the proportion of debt financing multiplied by the after-tax rate that we pay for the after-tax lending rate, plus the next one is the preferred stock. So we have weight of preferred stock times the cost of, or the rate that we pay for the preferred stock.
Scroll up, I'm not seeing it.
Seeing it now?
Yes, sir.
And then we have equity. All right, so the weight of equity or the proportion of equity financing times the rate that we pay for the equity financing. That's what the cost of equity is. So in the notes, you'll see in the slides, you'll see the definitions for each of the terms, right? The cost of equity, but just generally saying, when you borrow, when you get money, when you raise money or get a financing, it comes at a cost, and that's in terms of the interest rate that you pay. So all of these refer to the interest rate for the different types of financing. So KD, the after-tax cost of debt, is basically the rate after tax that you pay for the money that you're borrowing. The cost of preferred stock is the rate that we pay for the preferred stock money that we got, and so forth and so forth. Now, in your formulas, important, use decimals. Use decimal for the weights. All right, some people use decimals for everything, but you don't have to. But definitely use decimals for the weights. For me, I leave my interest rates as percentages. So the weight of debt would be what? For plan A. Somebody tell me that one quick. What's the weight of debt for plan A?
20%, sir.
Right, so it means we're going to put 0.2 times the rate. The after-tax rate is 6%. Plus, move on to preferred stock. The weight for preferred stock.
Sir. Sir.
Yeah, man, I'm hearing you.
So if they didn't give us the after tax, we'd have to work it out ourselves.
Correct.
Okay.
Yeah, I think the other example that we're doing, I think we're gonna have to work it out.
Sir, scroll up a bit.
Mm-hmm.
All right, okay.
Mhm. 7.0.
Oh, 0.7. If you want to put 701020, that's fine too. And that times 13%. So again, always best to work them out individually. So just in case there's an error with the final answer, you can get your partial marks. All right, so we have 1.2% plus 1% plus 0.7 times 13, 9.1%.
9.1.
So on the other part, we get 10.1, 11.3, right? So in this case, we are saying for the people who give us common equity, we're paying them a rate of 13%. For preferred stock, we're paying a rate of 10%. The after-tax rate that we pay for the borrowed money for the loans is 6%. When you balance everything out, on average, we are paying 11.3% for the money that we raise to carry out this plan A.
Sir, scroll up, please.
So using the same formula for plan B, we're going to have 0.30 times 7%. Oh no, that's not 7, that's 6.5. Plus 0.10 times 10.5%. Plus 0.60 times 13.5%. Again, we work them out one by one just to ensure that we get our partial marks. So just work these out for me, please. What the first one? 0.3 times 6.5.
I get 1.95.
1.95%. All right, plus
1.15, sir. 1.05, sorry.
1.05 plus
8.1.
8.1 flat. Remember, I want 2 decimals.
8.10.
Oh, 8.1. Oh, so cool. So no difference. All right, cool. So when we add these up, we get what?
11.10.
All right, cool. Let me just bring down these figures so that we have them right before us. 1 sec. All right, so the formula again now. So we're on to plan C. So I have 0.40 times 7%, 0.10 times 10.7% plus 0.50 times 14.2%. All right, so work out that one for me.
2.80.
Mm-hmm.
Ten points.
1 point.
Oh,
Mm-hmm. Yeah, the other figures don't need calculate. Well, this one never need calculator. Oh.
7.10%.
Right.
And 10.9%. 10.97%. Sorry.
Yeah, man. So it's straightforward stuff for the work, putting it together. Let me just copy the plan D. Give me a sec. Since formula up top, we can just pick it up. By the way, anybody who not clear on anything that we're doing, just ball out.
%4.50%.
Mm-hmm.
Sir, after this, the one where we have to actually calculate after tax amount.
Oh, we're going tomorrow. We're going through everything, man. Everything.
6.40%. All right. %12.02%.
All right, so my mental calculation not too bad then. All right, so and by the way, one of the things we're doing these questions, important to read, right? Because the question didn't ask us to just calculate them. I'm gonna go back up to the question. The question said, which of the four plans has the lowest weighted average cost of capital? So we had 11.3, 11.1, 10.97, and 12.02. So which one has the lowest squawk?
C.
Sir, plan C.
All right, so you notice that if you never state that, you can't get full marks, okay? Even though you do all the hard work and do all the calculations. All right, so this one is
Sir,
uh-huh.
question, we'll get marks if we don't do the calculation, but state which plan is the lowest one.
You don't want, put it this way, don't put me in a position to decide if you must get marks for that.
All right.
Yeah. Because we really give marks for the steps. All right, here's another one now that's a little different. Well, not a little different, very different. This one is more comprehensive. So notice we get the capital structure. And the capital structure is just the weight again. How much proportion, what's the proportion for each type of financing? That's all I mean by capital structure. Right, so 30% debt, 15% preferred stock, 15.5% common stock. And as usual, must add up to 100% else something is wrong. All right, then you're see a hand. Can you go ahead?
Sir, back to the question that you did before. Someone asked if they didn't give you, like, say we're using the plan D, they didn't give you the 9.0 and 11.2. How do you find them?
No,
Or
man,
it's already given? So
No,
which one you might not get?
No, man, it's either you get the rates or you get the information to calculate the rates. The question below, the one that we're gonna do now, you get the information to calculate the rates.
Oh, okay.
Yeah, man. So let's look at this one now. So we get the bond coupon rate. We get the bond yield to maturity. We get the dividend for the common stock, dividend for the preferred stock. And notice the word it says here. What does that mean? D1 or D0? The expected dividend for common stock.
D1.
Yeah, D1, because if it's expected, that means it's not come yet. We get dividend for preferred stock. Right, so we have to look out for these words. Because once you talk about common stock, you know, it's important to decipher whether you have gotten D0 or D1. All right, we have the price of the common stock. We have the price of the preferred stock. We have flotation cost for preferred stock. And in this case, it's not in a percentage, we get a dollar value. Right? We'll show you the difference with that. Growth rate, we have G, and we have the corporate tax rate. All right, so let's go through them one by one. The first thing we want is the cost of debt. Right? And for this one, we don't have to work it out because it's given. So don't get mixed up with the coupon rate. The coupon rate just says what's the annual interest payment. But what we want is a yield to maturity. Right? So if we're not given the yield to maturity, then that's what we'll be working out. Everybody understand the point I just made?
About the
No.
yield of maturity.
No, sir.
Repeat.
So, you say, no, so I'm not joking. So if I never ask them if I don't understand me, I wouldn't say nothing.
Of course,
Definitely
sir.
trying to
Somewhere
finish.
along the line, we would have picked
No,
up
wait
and
till they're done,
asked.
sir.
All right, I hear it. All right, and I will assume that what you're saying is true. All right, so this is what I said. I was typing it and then I'll say it again. Yeah, the cost of debt before tax is the yield to maturity.
So you're saying that they can use either state in terms of stating it?
Yeah, man, because that's what they did here. If you notice, the previous question had said what? It just told you the cost after tax, and then they broke them down one by one. This time, you are given two rates. You are given the coupon rate, and you are given the yield to maturity. And you are expected to decide which one is the correct one to use.
Sir, that we could eat?
No. Part of this thing is that you must know, so the overall return on a bond is the yield to maturity.
Noted, sir.
Right? The coupon is just part of the return. And it's overall we're dealing with. Right? So let's go through them one by one now. We want so KD before tax is equal to 11%. Right, so that's given in that second line. We're also given that the tax rate is equal to 30%. Right? We can now calculate the after-tax cost of debt for ourselves by just saying cost of debt after tax is equal to the cost of debt before tax multiplied by 1 minus the tax rate. Right? So to get the after tax, we just multiply by 1 minus T. So we have here is 11% times 1 minus the tax rate. And the only thing we use a percentage for is the cost, the interest rate. Everything else we use decimals. So we use decimals for our tax rate too. So 30% is the same as 0.30. So it will be 11% times 0.70 equal what? 7.7? Yeah, look like 7.7 to me. Oh, didn't I see your hand up? That was from the last time, right?
Oh, sorry.
Oh,
Didn't realize I still had it up.
oh yeah, man. It's still up here, Danilo. Yeah, man. All right. So talk to me. Any questions on this, the after-tax cost of debt?
Soaking it in, sir. Soaking it in.
Sir,
Yeah.
could you go over this particular question, please? This is the first I'm seeing this kind of question. What did you say was the what did the question can I see what the question asked us to do again, please?
Answer the calculator.
Sir, the short answer is in 0.077. Oh, that's percent. Oh, I
Yeah,
don't see you put percent on it.
yeah. It's okay.
It asks us to, it asks us to
WACC.
calculate,
WACC, weighted average cost of capital.
and we're supposed to use these information, the bond coupon rate and the bond yield to maturity.
Yeah. This is the whole question, you know, so we can only use what's in the question.
And what you said, sir, about the yield to maturity, that is this, it is the same thing as the required rate.
Hmm? That's what I said about the yield to maturity, highlighted in yellow. Hmm?
Sir?
Yeah. Yeah, Melanie?
Sir, I wasn't hearing anything, so I was wondering what's happening.
I'm on understand soaking it in, so I just allow a person to soak it in.
Okay, sir. My thing was, wouldn't it better for you to just put the formula there so they can see why we're picking out those things?
No, we're not ready for the formula yet, man.
Okay.
Yeah, this is what we're doing now is English language.
Sir, so isn't the formula that
So,
you
sir,
use, sir, when you say KD dt open bracket 1 minus t?
Yeah, that was the first formula we used.
Oh, okay. I thought so. Okay.
You how to calculate the after-tax cost of debt. Just multiply the before tax by 1 minus t. So yeah, this was a formula. Right, so the previous question had given us the after-tax cost of debt. This one just gave us the before tax. So we just multiply by 1 minus the tax rate to get the after tax.
Oh, so this is the after tax rate, sir, for debt.
Yeah, man, 7.7%.
Okay.
And what we need for the WACC formula is the after tax cost of debt.
Sir, scroll back up to the top question a bit for me, please.
Which part of it?
The part where the distributed the figures. Top. Okay, all right, cool, thanks.
Oh, yeah, man. All right, so I like to deal with things in order. So I deal with debt first. But you really don't have to follow that particular order. But trust me, life is normally smoother when I do things in a structured manner. All right, so after I deal with debt, I normally take care of preferred stock. And I take care of my common stock last. So we are given, and I can just jot beside this in bracket. It's given in the question, but I can just write it for a reminder that the weight of debt is what? Everybody see where that come from, right?
Yes, sir.
Yes, sir.
Yeah.
So these two things can take care of everything we need for debt. We need the weight and we need the after-tax cost of debt. So next one, the preferred stock. We are given the weight for the preferred stock, but we are not given the cost of preferred stock. So we have to find it using the formula. And we have been using that formula since we were doing, what was it, stock valuation? Yeah, we use that formula in stock valuation. So basically, so the cost of preferred stock is the dividend divided by the price. Right, so the same formula we use then, we use it back again. But the difference now is that we have a thing called flotation costs to consider. Now, what flotation cost refers to is this. It's almost like a banking fee. So when you're going to raise money via preferred stocks, anybody, this is just the other day, so they must remember this. JMB had a massive thing where they were advertise it whole heap, where they're offering some preference shares. Anybody remember that? Whole heap of ads they did. I think the rate was 7.35%.
Yes. Yes, man, scratch me with my man bones.
You remember it, Handel?
Yes, sir.
Yeah, man. Whole heap of ads got about it. Now, when they're doing these things, the advertising of it, the working out of it in terms of working out how everything should be assigned to the public, all of these things come at a cost. The person who normally does it is the investment banker. Fortunate for JMB, they also do investment banking, so they did their own services. It doesn't change the fact that there's a cost, but of course, if you are doing it, then it kind of make things easier for you. But the flotation costs are all of those fees to get this thing completed and properly processed, advertised, processed for the public and all of these things. So the formula changes a little bit when we are dealing with preferred stock. So I'm gonna I sent out a sheet in the WhatsApp group earlier today, right, with all of these formulas. But one of them said, it can be this if there's no flotation cost. But if you notice, you should see on that same sheet a formula looking like this. But in this formula, F represents the percentage cost. Let me just show that sheet again. But it's in the WhatsApp group. Give me a second. New share. Yeah. Yeah, so on the left-hand side, cost of preference shares. You notice two formulas. One says the dividend over the price. The other one says the dividend over the price times 1 minus F, where F is the percentage flotation cost. All right, everybody seeing the formula, right?
Yes, sir.
Right. So in this case, we are not given the percentage flotation cost. We are given the dollar value. Let me go back. I'm going back to the question now. Yep. Yeah. So if you notice, it says, we'll circle this. It says flotation cost for the preferred stock is $5.50. So we're not given a percentage, we are given a dollar value. Now, let me show you how that operates. Before I go to the formula, I just want to make sure you understand the logics of this thing. So the typing something on now, just going to see if it makes sense to me first. Just putting it in a certain way before I say it. All right, so I'm saying for financing, we get the price, less the flotation cost, which is the money that the investment banker take out of everything. So what that is saying is this. If we sell $1 million preference shares for $75 each. Total raise will be equal to how much?
$75 million.
Right. No trick there, so. We're just saying you sell 1 million preference shares and each one is sold for 75. How much money are you raising? 75 million. But at this point, we are ignoring flotation costs. Let's say there is a 10%. Yeah, let's say there's a 10% flotation cost. Right? The net amount raised would be, let me start with the net amount raised per share. Would be how much? So 10% flotation cost. What that means is, for every share you sell, 10% of the money go to the investment banker. So how much money going to go to the investment banker? Let me do this about. Let me do it another.
$5 each.
Yeah, the flotation cost per share, let me do it that way, would be 10% off, yeah, 75, which would be $7.50. Yeah, that should be clear enough. Everybody seeing that, right? If there's a 10% flotation cost, the flotation cost per share would be 10% of that 75. So for each share that you sell, $7.50 is going to go to the investment banker. So that means that for each share that we sell, we're not going to get $75, but we're going to get how much?
$67.5.
Exactly, because out of every $75 that we raise, we have to pay $7.50 to the investment banker, which leaves, yeah, looks like $67.50. So what that means is, looking at the money that we had said earlier, when we sell 1 million preference shares for $75, we're not really going to get $75 million from that effort. We're going to get 75 million less the money that we have to pay to the investment banker. Right? So what we'd really get is $67.50 times 1 million. So we'll get 67,500,000. Rest of money goes to the investment banker for their efforts. Tell me if that makes sense so far or not.
Yes, sir.
Right.
Makes sense.
So
Yes.
yeah, man. So that's all that there is. When they talk about flotation cost, it's just basically the money that the investment banker charges for their services in this whole process. They don't do it for free. Right? So when they say shares, the same thing happens when a company goes public and you see the IPO happening and you see all of these things. Like, for example, when one of them that was well advertised, Wigton, when Wigton Farms was going public, yeah, man, everybody and them uncle hear about it. You guys remember that one, right? Don't tell me no, because I'm most hear about Wigton Farms.
Yes, sir.
Yeah. Some people heard I didn't even know what it was. Cause I remember I was at JMB one day and somebody come in and said they want to the Wigton Farms. And they said, all right, let's go over there. They said, by the way, what is Wigton Farms? So they heard about the investment, or in their mind, is a way to make money, but they didn't understand what it was. So all that advertisement, I don't remember who the main investment banker was. I think it was NTB Capital Markets, I think. Could also be JMB, but I don't remember.
Yes,
But
sir. It's NCB.
NCB Cap Markets. All right, thanks. So in that case, the government who was the one selling the shares would really have to pay NCB Cap Markets for their services in the process. So when we talk about the shares were sold for, I don't remember how much money the shares were sold for. But out of the money that the government received for selling the shares, they're going to have to now pay NCB Cap Markets for their services in handling the whole process, right? And the money that they pay is that money is what we call the flotation costs, right? So looking at our question now. Oh, by the way, let me show you the one. This $67.50 now. So the denominator where it's a price of preference shares times 1 minus F. It would be 75 times 1 minus 10% flotation cost, so it's a 0.10 equals 75 times 0.90. And let's work that out for me quick. 75 times 0.9.
You get the 67.5.
Right. So you see that it's all it does is take out the dollar value of the flotation cost. Right? So going back to our question now, since we did not get a percentage, what we got was a dollar value. It simplifies things a little bit for us. So going back up to the question, it says the flotation cost So I'm going to put the figures now. In fact, let me just copy all of this down. So price of preferred stock, flotation cost for preferred stock. Right, so this is what we have, the price of the preferred stock. So price of preferred stock is equal to $98. That's what we're selling each unit for. The flotation cost is equal to $5.50. So what it means is that the money that we're going to get for selling the shares is not $98. It's $98 less the $5.50 that has to go to the investment banker. So we can say the net price is equal to $98 minus $5.50. And that gives how much?
92.50.
Sorry, 92.50. All right, so $92.50. That's a net price. So the formula about here can be rewritten as dividend divided by net price of preferred stock. Yeah, can be written that way. The dividend divided by the net price of the preferred stock. So once you have that, we know all we're doing now is just the straightforward division. $5.50 is the dividend. No, my bad. The dividend is given as well. The dividend was $10. Everybody see that, right? Dividend preferred equal
Yes, sir.
$10. So for our formula now, we're saying $10 dividend divided by the net price, which is $92.50. Right? So all of this is just pointing out that how we calculate the net price is different depending on whether we get a percentage or a dollar value. If it's a percentage, then we could work out the dollar value and subtract it like we did up here. Right? That's what we did up here. We work out the dollar value and we subtract it. Or we could multiply by 1 minus f like we did here. In both cases, for my example, we got the same 67.50. So when we get a percentage, we can treat it either way. But if we get a dollar value, we just need to subtract that dollar value from the price. So somebody tell me what this works out to. 10 divided by 92.5.
0.108.
All right, 108 flat. Would normally want 4 decimals.
1.
1. All right. Yeah, so 4 decimals, guys, for these things. Right, and this is the same as 10.81%. And we have been given the question that the weight for the preference share is 15%. So just to recap, Right, so to recap, so far we have cost of debt after tax equal 7.7%. And weight of debt equal 30%. We also have cost of preferred shares equal, I'll put on a percentage sign. Cost of preference shares equal 10.81%. And the weight of preference shared is equal to 15%. Remember, for each type of financing, we're going to need each of these. We need the cost, and we need the weight. So the last one that we need now is a common stock. Right? But before I move on to the common stock, I want to make sure we're comfortable with what was just done. So, questions? And I hear people quiet saying it's either that them lost or them too tired to ask question or something, but
The latter. Processing, sir. Processing.
all right. I know it's late still, so I know people are tired, but let's try. It's nothing difficult. It's just probably new in some cases. And what you're still gonna do, you're still gonna watch the lecture for me, right? To put things in perspective. Because this is just a snapshot.
Sir, so you're telling me that it gets harder than this, sir?
So I go again harder.
Yeah,
No,
it
man.
gets harder than this.
No, and when I say snapshot, I'm not saying harder. I said just to put things in perspective, just to make sure you have a complete understanding. No, man, these are the concepts that we test. For when it comes to common stock, there are two formulas. The sheet that I shared earlier. So it can be the CAPM formula that we covered already. We covered that for risk and return, or it can be the other formula that we looked at when we were doing stock valuation. All right, so let me move on to the common stock part. So let's read the question again. For common stock, it says dividend expected for common stock is $3. So let me just put that down. So D1 equals $3. Go back up, it says, so dividend expected for common stock, $3. Price of common stock, $50. So for common stock, price is that, so we just put P0. So P0 equal, I think that was what I just saw, 50. Yeah, price of common stock, $50. Then we have price of preferred, flotation cost, or growth rate. So the growth rate, the dollar sign shouldn't be here. That's a little error. Right, it shouldn't have any dollar sign there. It's just 8%. So the growth rate is G equal 8%. Yeah, so 8%. So the formula we have now, remember it's two sets of formulas. We have one for CAPM and we have one for straight. So the one without the CAPM, the dividend growth one says cost of equity equal D1 over P0 plus the growth rate. Right, so D1, we have that $3 divided by 50. $3 over 50 plus the growth rate, which is 8%. All right, so 3 over 50, that's 6%. So that's what I'm getting. 6 and 8, 0.06 plus 0.08, 0.14 or 14%. And we can also note that the weight of debt, so the weight of equity is equal to, scrolling up to the question, weight of equity 55%. After this, we have the three components. We have everything we need. We have the after-tax cost of debt, and we have the weight of debt. We have cost of preferred shares, weight of preferred shares. And now we have the cost of equity, common equity, and weight of equity. So let's go back to the work formula. I'm just copying to save some time for myself. All right, so weight of debt, 0.3 times 7.7%. Weight of preferred stock, 0.15 times 10.81%. And last but not least, we have 55 times 14%.
$7.7.
Yep.
$11.6.
Yeah, man, on top of things. All right, so this is what we're getting. For this question, right? Well, we started by just finding each cost. So we found the cost of debt after tax. We found the cost of preferred stock. Then we found the cost of equity, common equity. And we took it from there. Note also that just like how we have flotation costs for the preferred stock, we can also have flotation costs for the common stock. Right? Well, you see that in the notes still. All right, so good amount to absorb. I know this one, I see this one kind of have no more than the other one. Could be the lateness, could be the newness. But what we'll do is during the week when we are doing the tutorial sheets, we can seek to clarify or plug any gaps that we still have now. This introduction should at least cause the mind to be thinking in the right direction until then. Well, anybody have any questions or you want to throw me? Throw quickly. Any questions? All right, so the tiredness we know for tonight still. Yeah, but we know how it goes. All right, so you can soak it up. I'm gonna post it in the chat shortly, so you can look out for it. All right, so tomorrow,
Okay.
tomorrow when on the first one, you can go back through it.
Yes, sir. Okay, thanks. Good night.
All right, yeah, man, take care.
Thanks, sir, even though I fell asleep.
Yeah, I know I go, man. Don't worry yourself.
Mhm.
All right, ending the recording here.